You're watching Indian Open. We have with us the CFO of one of India's leading pharmaceutical companies, Mr. Ramesh Swaminathan. Thanks very much for joining us this morning. Let me start by asking you about the quick question that we're asking everybody in industry right now, and that is, are you seeing a waning of the GST-related problems, whether they were relating to how consumers were viewing some products and prices or supply chain and dealer issues? Is that now behind you almost?
I would say yes. May and June were months where we were tremendously impacted, but we saw normalcy returning in July, and August also turns out to be good. September turned out to be good till date. So essentially, if we believe that demand is back, the uptake is back, so I think the Indian market is certainly turning back to normalcy.
Should we expect any large costs this quarter that's underway in terms of one-time costs apportioned to GST? Because I know many companies like yours, even in the consumer space, have had to absorb some dealer losses on stocks, etc., etc. And of course, then putting in all the infrastructure in place for GST. One-time costs, but should we expect that for the industry?
Yes, for sure. That is certainly would be part of, in fact, quarter two results. There were reimbursements to the trade, and there's of course losses on account of deemed credits at our end as well. So both would actually be.
Okay, so let's now talk about the business and fundamentally how it's doing. What's the second half looking like for you? The big pressure point has been the US. Can you talk us through what you see coming up in the next few months?
US has been, in fact, a lackluster performance this year, more because of the fact that we had a pretty large base. As you'd be aware, both Fortimate and Glumetza came under pressure, more Glumetza, and that's the reason why, in fact, the Q1 results were impacted. And we had actually anticipated this and gone public with it quite some time ago. And of course, we do believe that this is perhaps the worst year. Next year onwards, things could be better. Because we've got a pretty rich pipeline. Next year, for example, we do have a lot of good products to bring into market. But I would think that the normalcy would actually return in 2021. In 2021? Yeah.
So are we going to continue to see a drop in your US revenue over the next 2 quarters?
No, I think this is going to be the worst
Are we
year.
stabilizing from here, or from this second quarter onwards, or will we continue to see cuts in your US business for the next few quarters as well?
No, what I'm saying is this year could be the worst, and after that I think you would see growth next year, but it's certainly not coming back to normalcy. It'll be a couple of years before we get to those levels.
So you're preparing us in the sense for the next few quarters, aren't
you? That's only for the US, but we've got a lot of other growth engines also. It is about 45% of our business, and you would recognize that you've got a pretty rich pipeline coming in for that. And of course, we talk about the medium term, you've got a very rich pipeline with the respiratory portfolio, complex injectables, and a host of other things, and of course, derma products and the like, and biosimilars also. But having said that, US is, of course, a very important engine for us. The other engines, of course, would be Japan, which continues to do fairly well. India would, we think, secular growth for the next several years to come. Emerging markets of Latin America, Brazil, and Mexico continue to do well. South Africa does well for us. So we have a lot of small engines also firing up.
I know Neeraj and Neera want to ask you questions. I just want a quick question on the revenue opportunity of the new launches that you spoke of. Can you talk us through that right now? Since you mentioned a few, some are already expected, we could put in names. If you give us a sense of what the new launches are.
So we have products like, for example, ranolazine coming in next year. Levothyroxine could be another product. Then you have the Velcols and Renagils, Renvela. All of these could potentially come in next year. Or Seltamavir could be another. So all of these are products, nothing in the same league as a Glumetza.
No, it isn't.
But having said that, these are all.
How large are these revenue opportunities? Will they benefit your margins in any substantial material way?
In a general sense, you would expect that anything in the tens would certainly be a decent product for any generic company, and that's where we are.
In the tens of millions?
Tens of millions, for sure. That's
what I meant. In the tens of millions?
Yeah.
Okay. But that could be anywhere between 10 to 100 million. So
that's for sure.
These are what, 50 million products, is it?
They are big in them, but there's competition, and all of that. So of course, there are a couple of products that we have, we do expect exclusivity. But having said that, there would be, and this is, the generic industry is all about a huge upside on launch and then a continuous downside.
Yeah. So actually, that's the key. I was just wondering how difficult does it become to forecast internally as well? What could happen over the next 2 years, considering that you and your peers and your colleagues, Nilesh Gupta, for example, at the investor conferences was saying that with the business models being challenged in a big way, how difficult does it become to forecast what's the kind of growth opportunity and the growth that the company could clock in over a 2-year period?
It is, business in every sphere is becoming disruptive, but in the case of America, it's more because of price erosion, and this has happened only because of the fact that there has been channel consolidation which has happened.
Yes.
The situation that we are in terms of Glumetza and Fortimet was perhaps unique to us, but there is, of course, a patent cliff also, so to the extent the number of products that we can re-engineer to bring to the market is also coming down. But that's we kind of expected all of that, and that's why we moved on to more complex generics, moving on to specialty, and that I think would be the order of the day when it comes to most generic companies.
Which is true, but my question purely is that if channel consolidation is going to continue to exert pressure in the near term, how long is the near term? Is it 6 months, is it 18 months, or is it difficult to say that right now?
But as I said, the generic industry is all about a huge upside on launch and a continuous downside, right? And that's the number of competitors could go up from 4, 5, 7, and so on. And of course, there is, of course, the channel consolidation piece also. Right. Next year could be another, spike only because in terms of price erosion, only because of the fact that you expect Express Scripts and Egon Disc to come together. That could potentially unleash another round of price erosion, so to speak. But in a general sense, the channel partners would also like to partner with companies who have a good record of supply chain metrics, quality and all of that, and that leaves us with very few competitors. So in that sense, they would also recognize it's rocking the boat too much will not really yield results. It's going to be counterproductive in that sense.
True. The other question, and I'm sure Ida and Minka have some other questions too, but if you were in this race, and as you have to be, to increase your share in complex generics, I'm guessing it involves substantial new expenditures of a nature that you didn't have to incur until now. Maybe distribution, maybe further reaching out to newer players as well. Is that the principal reason why your guidance for margins has come off? And would you believe that operationally you would probably be in the same range for the foreseeable future, the next 18 or maybe the next 30 odd months?
So let me answer this question that way. The complex generics and the specialty piece that you're speaking about would actually call for deeper pockets because it calls for clinical trials and the like. Specialty, of course, it also calls for skill sets of a very different kind. In some ways, our generic organic strategy has to dovetail into our inorganic pursuits as well. Because we need to have legitimacy with the doctors, which is very important. And of course, you get to own that space, and that's where M&A really comes in. And that would call for deeper pockets again, and of course, looking around and the landscape and picking out the right opportunities and all of that. And owning that space, of course, calls for skill sets of a very different kind. Clinical expertise is very important when you talk about organic endeavors also. Yeah, all of this is going to be deeper pockets for sure, and that's why you find our R&D expenditure has also been rising over time. So it used to be 7%, 9%, and it's now closer to 13.5%. But again, if you look at, in fact, bigger pharma, ethical pharma, it's close to 18%. I'm not for a minute saying that our expenditure base is going to go to that level. We would do what it takes to kind of contain it around 13%. But you also need to look at innovative ways of going about it in terms of perhaps partnering with the finance partner who would take on the full risk and potentially some part of the upside as well. But given the fact that a lot of these molecules have huge potential, what you would actually be sharing with them would be a smaller part of the overall upsides.
But so all of this leading to what? A consistency in the current margins, which are a bit lower than what you historically have enjoyed for the next 24, 30 odd months?
In this range, it's going to be muted.
21 to 23 is what you guided for.
About 20 to 23 is what we believe it would be.
And this is factoring in the additional expenditure on whether it is
all of that,
the organic plans or the inorganic plans.
All of that. But having said that, the depreciating rupee was actually, it's certainly going to give some upsides, but an appreciating rupee would have taken away that and so on. So to that extent, there are a lot of moving parts also out here. Yeah, but of course, the most important factor is R&D, which of course, is what we already explained.
Can we pin you down to some more specifics when you say inorganic strategy? What kind of size of businesses in this space, in complex or specialty generics, would you be interested in? Where would you see some sort of value addition to your efforts? What kind of outlay are you looking at for M&A?
So we have always professed our interest in women's health as well as the pediatric space. That's because we've got a franchise which has been around for some time. We already have a couple of products in both categories. Suprax, of course, was our anchor product in the pediatric space some time ago. It's come down substantially. But having said that, we are looking around for assets in the women's health space, and there are quite a few there in the market. Having said that, the sweet spot for us would be between $150 to $250 million per tranche. and we could do multiple tranches of this.
Per tranche, explain that to me. Sorry.
So potentially one molecule, we could.
Okay, so you'd be buying products, not the companies themselves.
It could be companies. It could be it could be a product. It could be.
So how much have you put aside, let's say, for M&A? Or how much have you earmarked?
If you look at our balance sheet, I think we've got capacity to borrow about $1 billion more. But that's So
you started with $150 to $200 million, and you just told us that you have the ability to leverage $1 billion.
We could certainly do that, but having said that, it's not as I'm going to expend that entire amount in one tranche. It's going to be, as I said, across multiple tranches and over time.
So you'd be comfortable to spend about $1 billion on an inorganic strategy to be able to build out the complex and specialty side of the business?
For sure.
That's
having said that, there is also continuous accruals. A lot of the pipeline is still rich, so I think the cash flows are pretty steady.
There was some news, just to tie up to that question, there was some news of you looking at a controlled substance plant overseas.
You already have one. You have it at New Jersey.
Another one that you're looking for?
No,
you're not
true.
looking for that.
Yeah.
Okay.
Yeah. Regulatory issues. What's the latest on both the Goa and the Indore facilities?
We believe that these issues will not get escalated, and there's a lot of optimism to believe that it will get sorted out in the next few weeks, if not within the quarter itself.
Yeah. I'm sorry, I don't know, but I know you've been saying that for a few interviews in the past as well. So what is it that doesn't? Is there no clarity and therefore you can't tell us more, or is it just difficult at this point in time to commit to?
All those issues that are raised with us, we've actually answered them satisfactorily, we believe.
So when do you get the next review, or when do you think that you might get clearance on this?
As I said, anytime now. It's going to be a question of a couple of weeks, or it could be a few months, a couple of months at very worst.
Okay. How is your India business looking? I mean, so much has been said and done about price control, etc., etc., etc. I won't repeat all of it, but I want you to give us some forward-looking idea, even if it's just strategic. In a general sense, I believe that the market is pretty good. It's a secular growth rate of around 15 to 18% is what you could expect from our company. The market could go at 10 to 12%. If GDP growth is going to be around the 6 to 7%, and that's what the government's intention is. But the fact is, even the new policy, there's a lot of emphasis on, in fact, expanding the NLEM, on affordability, really. But the issues really are on awareness of medicine, accessibility of medicine, availability of medicine. I think if the government does a lot more around that and builds infrastructure for those to take off, the growth could be much more. We are always the land of opportunity. Ramesh, sure, I don't know when in the past or in the future will anybody ever say that there is not opportunity in India. It's just the ability to actually see it fructify in any fashion, right?
I would think so. In the case of healthcare, I think it certainly would fructify.
So what are margins looking like in the Indian side of the business?
Oh, it's always been fairly decent, but it's more an ROC game. So we find a lot of the returns from our capital employed to be tremendous in this part of the world.
Yeah. Neeraj, sir, you want to ask?
No, just a couple of things. So you obviously stated as well, I think on multiple forums, that you and almost the industry would need a slew of new launches over the course of the next few years to, in a manner of speaking, stay relevant. I'm not using the term exactly, but stay relevant. How difficult would new launches be, maybe not for you, but for the industry at large, in the face of the fact that plants are not still getting cleared at the pace at which the industry would like them to be?
Plants, are you talking about the GDUFA?
No, I'm not just talking about Lupin individually. I'm just talking about the industry at large. The last 1.5 months, we were thought that the industry is now getting out of the hole, only to find a bunch of your peers, the observations sounding a lot more critical. For the industry at large, if new launches are the only way to stay relevant, but plants are not getting the clearances, how would all of this shape up then? There are
two parts to clearances. One is, of course, products are getting, expedited approvals are in place with GDUFA, and that's actually being demonstrated, seen in action, really. The FDA is a lot faster in terms of clearing products for launches today. The second part of the question relates to, in fact, the stringency on part of the FDA itself, and they are a very objective, and they are a governing body, and we respect their action that way. But there's a slight twist in the tail there. The fact of the matter is, for example, when we have a facility at New Jersey, and it gets inspected by, in fact, a local branch of the FDA itself, and when there is a bill or a Brown coming in there, is essentially there's a context to it, because he's been there, he knows what it is all about. Every time there is, this facilities in India get inspected, it's a new team, so to the extent the context is lost. And they look at, in fact, a lot of, today they would like to look at a digitized record, and that's where it is, In the past, you had companies looking at with integrity problems and so on, but that's not the way it is today.
Right. So
I think so.
Okay. So you believe you are completely confident of new launches from Lupins, and if not in this year, then in FY19, coming up at the pace that you are envisaging right now?
Yes, that's for sure.
And growth will come in only in FY19 as a result of the new launches.
FY19 there would be some growth, but FY20, 21 is when I think that there could be more growth because of, in fact, the newer filings that you're talking about, essentially from the respiratory portfolio, the injectables portfolio.
But Ramesh, you didn't give us a revenue opportunity number for the new filings. I tried, but it didn't work.
Well, that's what it is, so we don't give guidances.
Not guidance, but the revenue. I mean, some size of what you might be having in the pipeline for FY19.
I said that, I told you about...
no, in numbers.
That's difficult to actually conjecture.
Would it be conjecture?
At this stage, I don't want to do that.
Okay, fair enough. All right. So I think a last question on, what you see is the bottom line impact over the next 2 years. Will we see improvement substantially? Again, I'm trying to pin you down to some sort of number. I think you might not give it to me, but do you see that happening in FY19 and FY20?
FY19 will be certainly better than the current year, and it will progressively get better.
Okay, we'll just stick with qualitative descriptions, yes. Is it? All right, fine. Thanks very much. I know, like you said, your industry is going through disruptive forces, and it'll be interesting to see how you come out of this on the other side of things in the next year or two. Ramesh, thank you very much for joining us here at
My pleasure. Thank you very much.